Here are examples for simple and complex earnings per share. We need to calculate the weighted number of shares. And if you start with saying we have 200,000 shares on January 1st, and then on July 1st we got 400,000 shares, it's easy to calculate a weighted average. But that's not reality. For our example here, we start with 200,000 shares at the beginning of the year. And then on March 1st, we have 90,000 shares. So the 200,000 existed in that case for all of January and all of February, so that was for 2 months. In March, we had another 90,000, so we've got to add that for 1 month. But on April 1st, we bought back 85,000 shares of treasury stock, so we've got to take care of that for a month. Then we have a stock dividend, which was 15%. So that's going to change our weighted numbers. And the problem starts here. Now we have kind of a different set of shares. The shareholders are going to remain the same, but there's a lot more shares out there. The same thing with the stock split. All of a sudden we have double the number of shares. So what does that do to our weighting? Well, it really kind of recalculates everything. And then in July we reissue our treasury stock. So accounting for each of these is going to take some very careful analysis, and you really need to understand where your numbers are coming from. So what I've done is I've made different columns to keep track of all the changes in stock. Now, we'll start off and ignore the columns to the right until we get there. So first we're going to look at the date, the change in the number of shares, how many shares are outstanding, and the fraction of the year. We started with 200,000 shares, and they were there for 2 months out of 12, so that's 0.16 of a year. In March, we added 90,000, so the number of shares outstanding is now 290,000. That existed for 1 month, or 8% of the year. On April 1st, we had a purchase of treasury shares, which reduced the number of shares outstanding to 205,000, and that exists for 8% of the year. In May, there was a 15% dividend. So, of the outstanding shares, we had another 30,750 shares issued for a number of shares outstanding of 235,750. That existed for a month until things changed. What changed was this 15% stock split. And all those shares that we had at the beginning of the year were affected. So since that kind of affects retroactively, we have to go in and add the dividend of 115% to everything that occurred prior to this transaction. And now our number of shares is taken care of in the 235,750. On June 1st, there was a stock split. So the 235,750 now becomes 471,500. And that happened for a month before the next transaction. But it's really easy to see the 471,500, all of a sudden the number of shares doubled. That messes with your weighted average. So what we have to do is double everything before then. So we add a multiplier of 2 to our prior numbers. Then on July 1st, we have the 37,000 shares of reissued treasury stock, bringing the outstanding total to 508,500. This lasts for half a year. There's 2 things I want to point out. First is when those shares are reissued, they're issued as shares. They were not outstanding, so they did not get the stock dividend. They did not get the stock split. They're still simply shares of stock out there. So we just add them in at the 37,000. And the second thing I want to point out is when you add it up, we've only got 98% of the year. That's due to rounding. If you would take it out to 4 decimal places, it probably would take care of itself. It might be off by another 100th, but you can tuck that away somewhere. And I just kind of left it at 98%, so you see that rounding is an actual effect that comes into play. Now all we have to do is multiply everything out. So the 200,000 from January was 16% of a year, but we're going to increase it for the stock dividend take care of it in the stock split, and we end up with a new weighted average number. So that process continues. The 90,000 additional shares, so we had 290,000 shares that were there for a month, had a 15% dividend on them, had a stock split, and that month the weighted average is 53,360. Same thing with the reduction. Now we only have 205,000 shares because we had the T stock purchase that was affected by the dividend, and that month's weighted average would be 32,800. When we had the stock's dividend, we no longer have to account for it because that was included in the shares outstanding, but it was affected by the stock split that happened the next month. So we end up with 37,720. And that 37,720 is how many shares we would have outstanding after we took care of the dividends, which occurred before it, and the stock split, which occurred in the following month. So we end up with the 37,720. And if you look at it in June, there was no additional shares issued. So the difference between May and June should be zero, because if we've taken care of the dividend and the stock split for the month of May and not issued anything for the month of June, we ought to have the same number of weighted average shares for that month. And that's what happens. If you take the number of shares outstanding of 471,500, multiply it by a fraction of a year, which is 8/10, you should have 1 month's weighted average share of 37,720. The fact that it agrees with what we have in May says we've done things correctly. So we can move on. In July, we reissued 37,000 shares of treasury stock. Those shares of treasury stock were not affected by the dividend or the split. They were shares that we just reissued. And so we just add them to the balance, and we end up with 508,500. And nothing happened for the second half of the year, so we multiply it by 50% of the year. That is a 254,250 as a weighted average. And the total weighted average for the year of number of shares is 489,450 shares. We take those weighted average number of shares and we use them for the basic and diluted earnings per share. But for our example, we're not going to go through that big process of calculating the weighted number of shares. We're just going to pretend we've already done that. And for this example, we're going to use 100,000 shares as our weighted average number of shares. But this is the regular number of shares. We're not taking into consideration what happens if the shares are converted. So in its most simple form of earnings per share, we would have one set of stock, one number for weighted average of ordinary shares. And that's what we're going to use for this example. But just to be clear, our numerator for the simple earnings per share is net income available for the common shareholders. We really calculate that as net income minus the preferred shareholders' dividends. And the preferred shareholders' dividend is going to be the percent, because that'd be 8% preferred, so it would be 8% times the par value times the number of shares. But we're going to assume very simple for this example so we don't keep adding extra things to confuse. And just know that if there was preferred, this is how you would deal with it. So what we're going to talk about for a very simple earnings per share is simply the net income that you have of $210,000 and the weighted average ordinary shares of 100,000. If we go ahead and make our numerator net income available for common shareholders and our denominator weighted average number of ordinary shares, we end up with the simple earnings per share. And it's also called the basic earnings per share. It's usually the highest amount you would have as earnings per share. Now, as we're going to go on, we're going to dilute that. Because if individuals, the investors, converted their shares into common shares, we would have more than 100,000 shares in the denominator, and the earnings per share would go down. It would be diluted. The big responsibility we have is to start with $2.10 as our basic earnings per share. And as we account for each of the conversions, if earnings per share ever increases beyond that, that's considered anti-dilutive, and we can't use it. The conservatism principle says keep things as conservatism or negative or low as possible. And if you look at each of the amounts that are given to you with regards to the convertible bonds, you see that bond A was sold as $1 million, and it can be converted into 20,000 shares. There's also an interest expense associated with it. And while we just talked about diluting the earnings per share by increasing the number of shares, there's a benefit to this. If those bonds were converted, there wouldn't have to be the interest expense of the $62,000. That would have been saved. So net income would have been higher by $62,000. But if it's higher by $62,000, it also would have been taxed. So it's not quite $62,000 that's higher. It's really $62,000 less 40% higher, because that would have been the tax associated with it. And that's what we're going to deal with. My earnings, my net income available for common shareholders is going to be increased by the net of tax of that bond interest. So the numerator goes up by the increase in net income, and the denominator is going to go up by the number of shares. The same thing happens with bond B. Except notice that bond B was only around for 9 months of the year. We don't have information for that for bond A, so we're going to assume it was for the entire year. But our interest expense, because we're going to deal with this on a weighted average, and what would have happened, we're going to have this for 9 months of the year. So this is where we go. We take our income for common, which was the $100,000 that we started with. We take the interest expense net of tax for bond A, and the interest expense net of tax for bond B, and we've got a new numerator. This would be the income available for the common shareholders. Now our denominator is going to be the same kind of thing. We have the weighted average of 100,000 shares, which we start with. We have the 20,000 shares. If bond A was converted, they would have been in existence for the entire year. Bond B would have been 32,000 shares, but we only have it for 9 months, so that would have been 24,000 on the weighted average, and we have a new denominator. So when we take the 283,200 divided by 144,000, we get a diluted earnings per share. That is 197. We always go back and compare, is 197 smaller than 210? Yes, it is actually a diluted earnings per share, and we need to show it. But what if A's conversion was only for 10,000 shares? It's really right here, we did it for 20,000. But the process could change, the conversion amount could change, the number of shares could change. So we would actually have to go and change this. I didn't change the interest expense because we didn't change the bond. The interest is still going to be the same. What we're really doing is we're saying instead of 144,000 outstanding, weighted average outstanding shares, we would have 134,000 outstanding shares. To put it into process, we still have the same numerator, so we're still adding all those things, and this 10,000 is what we dealt with. That's why we end up with 134,000. There's a big difference, though. with basic earnings per share, we had 2 to 10. When we did it the other way, with 20,000 shares, we had $1.97. But when we do it this way, we have $2.11. This is a problem. The earnings per share has now increased, so it's anti-dilutive. We can't show an increase in earnings per share, so therefore we can only show on our financial statements the basic earnings per share. And that's the conservative approach. That's what we need to present to our shareholders.